Hi, my name is Nikita Aggarwal, and I'm a researcher based at the University of Oxford. So today I'm going to present an overview of my recent paper, Fintech Credit and Consumer Financial Protection. This paper charts the growing phenomenon of fintech credit. It examines the consumer protection risks due to fintech credit, particularly for consumer privacy. And it considers how existing regulatory mechanisms could be redesigned to better mitigate these risks. So to begin with, what is fintech credit? I define fintech credit in terms of three overarching trends: digitization, disintermediation, and datafication. And let me briefly describe each of these trends in turn. Digitization, this refers to the shift from analog to digital technology in consumer credit markets. Of course, this is a trend that has been in motion for several decades. However, it has accelerated significantly, particularly since the early 2000s, with the wider diffusion of the internet, personal, mobile, and cloud computing. Disintermediation, then, by this I refer to the dislocation of traditional financial intermediaries by technology-led peer-to-peer lenders, companies like Zopa in the UK or Lending Club in the US, and then more broadly, non-financial, non-traditional actors like the big techs, companies like Apple and Amazon, who are increasingly expanding their consumer finance offerings. And finally, datafication. This refers to the increasing reliance on data, but particularly non-credit, non-financial, so-called alternative data in consumer credit decision-making, as well as data-driven computational methods like machine learning. So under fintech credit, a consumer can now take out a loan using little more than an app on their mobile phone. Likewise, the lender can assess the borrower's creditworthiness and communicate with the borrower and monitor loan repayments, all through an app and largely using data-driven digital technology. It's important to recognize as well that fintech credit, as defined in this paper, embraces a range of entities, business models, and regulatory models. So it includes both new fintech startups as well as traditional financial institutions, non-bank platform lenders, as well as banks, and increasingly partnerships between the old and the new. Indeed, to the extent that all credit providers are turning increasingly to data and digital technology, well, we could say then that all credit is or soon will be fintech credit. So what then are the opportunities and risks of fintech credit for credit consumers? Well, as with all advances in technology, fintech credit presents both opportunities as well as risks. So on the one hand, fintech credit stands to benefit consumers by reducing the cost and the complexity of obtaining credit. Automation through the use of machine learning could reduce unfair discrimination in lending by reducing human prejudice in face-to-face loan assessments. And the same technologies could improve access to credit and improve personal financial management. On the other hand, however, fintech credit could harm consumers. Lenders can abuse their data-driven insights to more effectively profile and target consumers, for example, with unfavorable credit offers. And the use of machine learning and alternative data could perpetuate or amplify unfair discrimination, for example, due to biases in the underlying data, as was demonstrated by the recent Apple Card debacle. More importantly, fintech credit, with its heavy reliance on consumer data, threatens consumer privacy and therefore consumer autonomy. Lenders can now preempt and predict our behavior and shape our identity in much more granular ways than in the past. This diminishes our ability to shape our own identities. And the commodification of personal data for lending decisions, particularly intimate health or relationship data, really raises moral questions about harms to our dignity. So one of the major challenges then of regulating fintech credit is navigating these value trade-offs between potential gains and losses for efficiency, fairness, and privacy in consumer credit markets, and the respective benefits and harms for consumers. In this paper, I suggest various ways in which the regulatory frameworks governing consumer credit markets could be strengthened to better mitigate the consumer protection risks due to fintech credit. This includes strengthening model validation and data quality verification requirements for the use of machine learning and alternative data in consumer credit decision-making. Clearly, fintech credit also requires stricter data protection regulation due to the consumer privacy risk. Existing market-based mechanisms like contractual consent and rights such as the right to data access and data portability are inadequate to protect consumers in increasingly datafied consumer credit markets. These are markets characterized by steep asymmetries of information and power between borrowers and lenders, and negative externalities to data processing, such that private ordering remains inadequate to truly safeguard consumer data and consumer privacy. What is needed is a much stronger top-down approach, stricter regulatory obligations on data processing, including a higher justificatory threshold for the use of personal data in consumer credit decision-making. More fundamentally, I argue that the growth of fintech credit and the datafication of consumer finance more generally calls for a rebalancing in the norms of consumer financial protection. Clearly, fintech credit makes consumer privacy increasingly important to the overarching goal of consumer financial protection. Indeed, privacy is consumer financial protection. Under the status quo, however, at least in the UK, consumer financial privacy is governed in the first instance by data protection regulation and primarily monitored and enforced by the data protection regulator. This bifurcation, I suggest, has created a consumer financial privacy gap, whereby the privacy of credit consumers is under-monitored and under-enforced. The paper therefore calls on consumer financial regulators, in the UK, the FCA, to interpret their consumer protection mandates more broadly and more holistically to include the protection of consumer privacy.